And I wanted something that people would be inspired by, that they could use. And the premise was there's so many different asset categories out there. There's so many different ways to invest that individuals have a hard time figuring out, well, what do I do? Stocks, bonds, commodities, real estate. How do I compare and choose to decide how and where to invest? And so that was sort of the basis of it. Here are 10 questions that you should ask before you invest in anything. And as new asset categories come along, these 10 questions will help with that because it's principle based. And that was the reason for it and what I tried to accomplish with the book. With the goal so that people didn't stress out so much about investing, that we do not need to be experts to invest.
Hey, it's Rocky. Welcome to Richer Soul. Today's guest is David Stein from Money for the Rest of Us. He will share his wisdom on successful investing. Imagine it's 12 months from now, and you've achieved your major life goals. How does it feel to be in the best shape of your life, to wake up energized, excited about the day, to have great relationships and friends who support you and propel you forward? How does it feel to have an excess of money, to be able to make the choices you want, to be fearless and open to trying new adventures? Imagine being connected to the universe and it providing everything you desire. It's possible over time, and your past does not dictate your future. The only thing holding you back from this vision is you. It's time to take control of our thoughts and use them to our advantage. Welcome to Richer Soul, where we achieve our dreams and bring balance to health, wealth, relationships, time, and spirituality. If you have not had a chance to listen to episodes 1 through 9, I encourage you to go back and listen to the framework behind Richer Soul and how to create the life of your dreams. You can also find all the show notes for this episode at richersoul.com. While you're there, you can sign up for a monthly email where I share the best articles I read this month, let you know about upcoming episodes, and share a little wisdom. You can also listen to coaching calls under the Coaching Calls tab. I also share the most interesting articles I read every week on Facebook at facebook.com/Richer Soul. And there's also a Facebook group where you can ask questions and interact with other listeners. Today's quote is from Anthony DeMello. Think of some of the painful events in your life. For how many of them are you grateful today? Because thanks to them, you changed and grew. Here is a simple truth of life that most people never discover. Happy events make life delightful, but they do not lead to self-discovery and growth and freedom. That privilege is reserved to the things and persons and situations that cause us pain. Probably not what you want to hear. As we look back on struggles in life, we many times see how they formed us. As you listen to David's story today growing up, listen to see how his struggles served him. We all have them, and they serve a purpose. We can either grow from them and allow them to push us forward or to hold us back. That's a choice we make. Last week, Sean shared his action step, which was to ask yourself, do you want to be where you work now in 2 to 5 years? Today, David's going to expand on that concept. So, do you want to be working where you are in 2 to 5 years? Or do you have a plan in place for what you want to do next? I know I went through this exercise, and it took me a while to get where I want to be in my work. Now, I could do this until the day I die. I'm excited for today and have wanted to have David on the show for a while. His new book is the perfect reason. Listen in as he explains the difference between investing, speculation, and gambling. Too often we're confused by what we're really engaged in. I wish I had been smarter in investing and had a better principled approach. My results would have been astronomically different. But then, I wouldn't be who I am today. I think I prefer who I am to having more money and not learning to improve myself and overcome my shortcomings. David Stein helps individuals become more confident investors via audio, video, and books. For the past 5 years, he has hosted the weekly personal finance podcast, Money for the Rest of Us. The show has more than 250 episodes and over 12 million downloads. David is the author of Money for the Rest of Us, 10 Questions to Master Successful Investing. Previously, David was Chief Investment Strategist and Chief Portfolio Strategist at Fund Evaluation Group, LLC, a $70 billion institutional investment advisory firm, where he co-headed the 21-person research group. Let's meet our guest. Welcome to Rich Your Soul, David Stein. It's great to have you join us today.
Thanks for having me.
And I'm excited for the conversation. I got a chance to read your book, and I'd love to learn a little bit more. But before we do that, we always start at the beginning. What was it like when you were growing up, and how much did your family and school teach you about money?
A lot, mainly because there wasn't much of it in terms of, I come from a background of mostly single parent. My dad was an alcoholic. He eventually recovered, but most of my childhood was figuring out, where we would get money. And so that became sort of a frame, and realized that as I was older, I did not want to be in that situation. And so that probably prompted me to spend more time than most kids studying first entrepreneurship, marketing, eventually finance and investing. And so that was a big component of that.
And you said you did that as a kid.
I did. I remember convincing my mom when I was probably at 10 or 11, maybe 11. Someone had run a full-page ad in the Cincinnati Enquirer that had a big RV on it and said you could get an RV. You could make enough money to get an RV, which I didn't really want an RV, but the idea that you could learn how to make money in a way without having a job, and convinced my mom to go buy this course, which basically was a course on copywriting. But yeah, from an early age. And about that time, my mother had got into selling real estate when I was about 11 or 12. So I had a lot of influential books and tapes come into my life, Zig Ziglar and Dale Carnegie and Think and Grow Rich and all these things. So yeah, I sort of overindulged on self-help success literature as a 12-year-old. And as a result, can't read it anymore. It's like I had my fill of that.
And that's quite interesting, because most 12-year-olds aren't going to pick up that stuff. They're not going to read it. And there's usually not that desire there. But I guess you had some kind of burning desire there because of your situation that caused you to step up and say, I want to do something different. That's quite interesting.
And I found it interesting. I mean, I was launching little businesses as a 12 and 13, 14-year-old, just trying things out. I had a P.O. box, was running ads in newspapers. Most of it didn't work. But it sort of got me. I mean, if it had been like it was today, it would have been way, way easier with the internet and the other tools. But back then, you had classified ads in a P.O. box and hope.
And hope. And that's a bit expensive because it costs money to put ads out and to do all of that. But it's interesting that you actually went through that and you actually did it. So are you doing something different to teach your kids about money?
Well, I mean, mostly, and I've talked to them about what we taught them about money over the years. Much of it was informal. Much of it was by example. One of the key concepts that we taught is money is not something that we hoard. Money flows. It flows in, it flows out. And we shouldn't be overly obsessed about money, are worried about money, that there will be enough if we follow the principles of sound finances, that there'll be enough. And so, I didn't want my kids to grow up overly fretting about money. And we were always very open about money. When we take a vacation, we would say, here's what it cost. And so there was an open dialogue about money. And so it wasn't a topic that couldn't be discussed. And as a result, they grew comfortable knowing, like, here's how money works, and realized that they valued freedom and time more than they valued money, and have structured their lives they're all in their 20s at this point. So, they're still figuring it out, but, they've structured a life that isn't involved in being overly consumed about money.
So they're not following a traditional path?
No, nobody got a degree in engineering or accounting, unfortunately. I won't say that's unfortunate. They're all liberal arts majors. They've seen their dad, who's worked for himself for either as a partner or by himself for much of their life, and they don't want to just sit at a desk all day and work for the man.
And I get that. My daughter's seen my wife and the way she works, and she has no desire to go into corporate. My son is still figuring things out. He's going to go for engineering, but he actually likes to put his hands on the tools and build and design and program. So he'll have to figure that out as well. And they all do eventually, and they figure out the path that works for them. So you kind of stayed in the money business. You got out of college and you went into the financial advisory world. Can you share your experiences there?
Well, sure. I didn't give a whole lot of thought to my major. I remember being, as an undergrad, figured I needed a job, so I would study business because businesses gave jobs, and a stockbroker got up one time and kind of introducing the different areas of business, and he said he could make $100,000 a year, and I thought, well, I'd like to do that. So I became a finance major, and eventually learned to like it more than I might have at the beginning. But at undergrad in finance, I got an MBA in finance, and then I worked in the corporate world as a credit analyst and a financial analyst for a couple years until I ended up with this small 25-person institutional advisory firm. So we worked mostly with endowments and foundations, providing guidance, and I had a pretty simple career. I was with them for 17 years, and in my mid-40s, I flew in on a red eye and said, I'm done. You can buy me out now, my partnership, and that's been about 7 years ago that I left that.
And so I know on a recent podcast episode, you talked about a settled life. And it's a very interesting concept. And I think it's been a constant conversation, especially as you hear a lot more about the FIRE community. A lot of people are talking about, we don't want to retire. We don't want to give up, but we also want freedom to make the choices that we can make in life and be able to do that. And it sounds like your concept of a settled life is exactly that. Can you share that?
Sure. It's a concept from Christopher Alexander and his co-authors. It's a book called The Pattern Language. It's actually a book on architecture and design. And they introduced a concept called settled work, which was work that you do generally in the later years of your life that can carry you well into the retirement years. It can be work with your hands, it can be writing. And they were approaching it more from your house should have a workshop or something where you can do this settled work. And their point was it can take a long time to figure out what that is. So it isn't something we do just for the money. We do it because we enjoy it. And that takes time to figure out. And that was the point of that episode, that what I do now, podcasting, writing books, just teaching, that idea, that seed of the idea, I started working on that 20 years ago when I realized that even before that, I remember my first day at the investment advisory firm. I think we were on the 17th floor of an office building, and it was mostly bank employees in that building, and most of them were complaining. about their job. And I decided, I think I was 30 when I started with that company. And I decided right then, I'm not going to be in that situation. I will not be 50 and be complaining about my job and feel trapped. And so the whole idea is to structure a life where I didn't have to be trapped, and ultimately to find a life where, I could earn enough where people would just pay me to learn and to grow and to be a service as I share what I learn. And so, but it takes years to figure out what that is. And we experiment. I did an episode this week on that. I had a listener, he's 22, he's working in finance in Canada, and he's saving for retirement, and he's saving for a house, and he's saving for a car. And he's frustrated because he feels like his money's going everywhere, and he's not able to spend anything on things he enjoys. And we talked about the importance of spending money on ourselves, particularly on tools and other things for self-development, because that's where we pick up skills and pursue activities that eventually can be the settled work, the things that we want to do for much of our life. And we don't know what that is until we try different things out. And that takes dedicating some resources to that.
That it does. I've kind of been on this journey as well. I knew I wanted early retirement, and I built the financials to be able to do that. But then came the question of, what am I going to do when I stop corporate work? And what does that life look like? And this podcast has kind of come out of that journey. And now I feel like I'm in that settled life, I think, or at least working towards it. I don't know that you ever figure it all out, but I enjoy the ability to make the choices I want to work with the clients that I want to. And I enjoy that constant learning and helping and inspiring people to go out and live life on their terms instead of being stuck working for somebody else. Or and maybe you love working for someone else. There's nothing wrong with that. But at least being in love with what you're doing every day, waking up with excitement to face the day and not dreading things and not waiting for some time in the future when you can finally enjoy life.
Well, I agree. And I've told my kids, if you have structured a life where you're dreading Monday morning, then I feel like we have failed as parents. That they have to be willing to find a way that they get satisfaction in what they do on a daily basis. I call it live like you're already retired, in that figure out an activity that you can pursue for decades and find rewarding that meets your financial needs.
And that is great advice. I think now the one thing I would struggle with is with the world changing so fast. I don't know. I guess you change with it, right? You flow with this. And as the world changes and as technology changes things, the same principles apply. You just find new ways of doing it.
Well, sure. I mean, people will always pay if they're being helped. If you're serving, they'll pay for that. They'll pay for trust. If they trust you, you can get paid for that. Now, how you deliver whatever you deliver, that changes. I mean, you and I podcast. Podcasting didn't exist 20 years ago. What we do for a living, I mean, that job category didn't exist. So yeah, technology changes. But human nature doesn't change, and people want to be helped by people they trust. And that's what, our kids can't do anything they want. At the end of the day, they have to do something that people will pay them for. And generally, it'll be something that is helpful to people.
Provide value, right? The more value you provide, the more you get paid. I think that's a Zig Ziglar quote somewhere in there with regards to that. So you recently wrote a book, Money for the Rest of Us, 10 Questions to Master Successful Investing. Why did you choose to write the book?
I mean, the straightforward answer is an agent from New York called me up and asked if I wanted to write a book. So he kind of prompted me to. But more so, I found after 5 years of podcasting, I had so many episodes, and that I wanted something more permanent, and to be able to take here was the pitch from the agent. This is what got me interested. He said, his dream was to work with somebody to produce a useful investing book that would last through time. So something perennial, so principle based. And to me, that was an interesting challenge because I've taught investing for over a couple decades. I've invested, and I wanted something that people would be inspired by, that they could use. And the premise was there's so many different asset categories out there. There's so many different ways to invest that individuals have a hard time figuring out, well, what do I do? Stocks, bonds, commodities, real estate. How do I compare and choose to decide how and where to invest? And so that was sort of the basis of it. Here are 10 questions that you should ask before you invest in anything. And as new asset categories come along, these 10 questions will help with that because it's principle based. And that was the reason for it and what I tried to accomplish with the book. With the goal so that people didn't stress out so much about investing, that we do not need to be experts to invest, that we're going to make mistakes when we invest. The key is to understand the rules of thumb or the principles so that we keep our mistakes small and go from there.
And that, I guess that's a very true thing, is when you're learning, don't bet the farm, right? And number two, understand that if you make a mistake, you've learned something. And once you learn something, start using that knowledge to continue. Because what I find a lot of times, especially I think even on the stock side, although I don't have those conversations as much, but on the real estate side, people get involved with real estate. They buy one property, they have a bad outcome, and they give up. And they don't go back, which is a shame because you learn something. And if you don't use the knowledge you learned to take the next step, then the lessons probably weren't worthwhile.
Well, sure. Annie Duke, who wrote the book Thinking in Bets, she's a decision strategist, a former professional poker player. She endorsed my book. She's on the cover. And one of the quotes of hers I use in my book, she says, we can't let a bad outcome, basically beat ourselves up over a bad outcome, because a bad outcome doesn't necessarily mean it was a bad decision. We need a good decision-making process. And sometimes the outcome won't be what we would like, but as long as the decision-making process was appropriate, then it was a good decision, even though in that particular round, the outcome wasn't what we had hoped.
And that's an interesting thing, because I think what happens sometimes is people make a decision, they get lucky, and then they think they figured it all out, but it was probably more so luck that caused that great outcome than an actual decision process and framework. And I think I know for me with finances, and I still struggle with this, I don't think I have a good decision process and framework in place to make principled investments over time. Like, I'm good with real estate. I can sit down and do paper and pen to real estate and say this works, this doesn't, and it's a good bet. But when it comes to stock investing, I find it harder to do that. And part of the reason, I think, is because the past doesn't dictate the future. And I think that's one of the biggest mistakes I made when I was younger, was always chasing returns, always to buy at the wrong time and sell at the wrong time. And I think you talk a little bit about that in the book, and I'm sure you've got comments on that with regards to how do you forecast the future?
Well, right. I mean, the early example, people that can't separate skill from luck. I mean, one of the opening stories in the book is an exterminator at our farm and asked me, how much can you earn investing? And before I could answer the question, he answered it for himself. And he said, I think 80% is what we can earn investing in stocks. And it turned out that was what he had earned that year on the one and probably the only stock he's ever bought in his life. And I tried to explain that, no, that's not reasonable. And I think, just like Rocky, you do with real estate, I mean, you look at the return drivers. I mean, you're looking at the rent and you're coming up with an assumption for perhaps appreciation or what is the value. We have to do that with all investments. We need to understand the return drivers. With stocks, it's dividends. In fact, most asset classes, it comes down to three things. It comes down to the cash flow being generated, be it dividends, rent, or interest. How is that cash flow growing over time? And then how are other investors valuing that cash flow? What are they paying for that cash flow stream? That drives returns of every asset class. Now, some asset classes have no cash flow, in which case the only thing that drives the return is people willing to pay more in the future or less. But these are the kind of principles that I think from an investment, if we just step back and think about, okay, what has to happen for this investment to be successful? What are the drivers of this investment? And it's not that we're trying to predict the future. It's having reasonable expectations. So we don't go out and start buying individual stocks because we think they can earn 80% and then are disappointed when they don't. It's having reasonable expectations founded on rules of thumb, return drivers that drive asset class returns.
And you were in the financial advisory world, but I think I hear you say, do you buy individual stocks?
I don't buy individual stocks. I mean, as an institutional investment advisor, we managed money, but we've always were asset class focused. When you work with a $200 million endowment, you're not sitting buying individual stocks for them. You're allocating their assets just like an individual does. How much in stocks overall? How much in bonds? How much in real estate? How much in other, let's say, private investments? And so that's sort of my training in investing didn't come from buying individual stocks. It came from an asset allocation framework. And that's what most individuals should do. One of the things I talk about in the book, when we think about return drivers, is, if you're buying an individual stock, that's an act of arrogance, because what you're saying is the price of the stock is wrong. We don't buy an individual stock because it has cool products. We don't buy it because it's growing its earnings quickly or it just made the news. We buy it because we believe that the price that the stock is selling for, the consensus of what investors have come to the market and decided this is the price for the stock. We buy it because we believe it's wrong, that they are wrong. And the reason why is because every stock has an embedded growth rate in it in terms of the cash flow in case of the earnings. And so the only way a stock is going to outperform the market is if its earnings come in better than what everybody already expects. And that's where people fall a little short, because they just think it's going to go up because earnings go up, but it doesn't matter. It has to go up more than what everybody expects. And so as an individual, I don't buy individual stocks because, one, I don't think I have the informational edge to determine that stocks are mispriced. I'd rather focus on asset classes overall, where I can see that right now the market isn't paying a premium for a given asset class, so I'm comfortable investing in that. And I don't have to make a specific bets on specific companies within that asset class.
Do you think there are people skilled who can make great stock choices, or is that not normally the case?
No, there are definitely people that can do it. I would say the overwhelming number of professionals don't do it and can't do it. Individuals typically aren't able to do it either, but there clearly are people that, you have, and Warren Buffett talks about this, right? To be, the skill Warren Buffett has is the ability to value business and to say that this business is attractive at this price. But most professionals underperform the market, net of fees. Most individuals do also, except individuals typically don't they forget about the bad investments. They only remember the good ones. They're not actually tracking their performance in the same way professional managers have to every single month. And I did this. I managed, not only did we provide investment advice, but we actually managed money. And so I was held accountable for performance. And it's very, very difficult to outperform because you're trying to predict the future. And it's very, very difficult to do that. That's why I invest what I call on the leading edge of the present, understanding what is happening now and making reasonable decisions based on where things stand now. And when we invest in something that's cheaper than average, then it potentially has more embedded surprises in it, as opposed to buying something that's very expensive that's priced to perfection. So no, I don't buy individual stocks. And I think most individuals shouldn't, other than for fun, to learn. I mean, it's a great way to learn, but you don't want to stake your retirement on something so difficult as predicting the future.
And I think that's very true. That's a hard-learned lesson for me. And I still struggle with it, because you hear a good stock tip and you're like, oh, I don't want to miss out. And so you get excited, and it's dealing with, I guess, human emotions, right? And how we behave.
And you could. I mean, here's the thing, and this is where I'm not saying never buy an individual stock. I mean, if you hear an idea, you think it's interesting, you do some research, it's okay to put some money on that, especially because commissions are free. But then track the returns and to see, all right, yeah, this one worked out. This one didn't work out. On average, here's my portfolio at Robinhood. Here's the performance of my Robinhood account where I have put the individual stocks that I am investing in. And then see how one does relative to, let's say, the overall stock market, the S&P 500 or some other index. So if we're going to do it, hold ourselves accountable to calculate the returns over time.
And most people do that. That's like the gambler's story, right? They always tell you when they win. They never tell you when they lose. And we tend to sweep that under the rug and forget it ever happened.
And it is fun to invest in individual stock. I mean, I've done it and I've learned my lesson just like you. And that's part of investing, is experimenting. I mean, I bought a closed-end fund, an investment the other day. And I run a membership site, and on the forum, a member pushed back and basically said, "You're crazy to have bought that investment. It's just way too risky." And I bought a really small percent because I bought it so I could see how it behaves. And so I could spend time analyzing it and to some extent teaching about it. But part of investing is making these small investments so that we can learn from our mistakes or just so we can learn, period.
And that's very true. So you talk about it, and I think you use 3 words, and we should probably clarify this for everyone. You talk about investing, speculation, and gambling, correct? Can you explain the differences between those?
Sure. Investing and this comes from a gentleman named Dr. Kingsley Jones, where I really liked his definition. He's got an investment firm down in Australia. And he says an investment is something that has a reasonable expectation of having a positive return. So positive expected return, and the reason why is for those reasons I talked about earlier. Typically, there's a cash flow component to it. There's an income stream that allows it to have a positive return. Because even if the price falls, if it's possible to still make money at it. A speculation is something where there's some disagreement whether the return will be positive or negative. An example of that would be gold or antiques or cryptocurrencies such as Bitcoin. And the reason why there's disagreement is because there is no cash flow. It depends on if it's going to make money. It depends on somebody paying more in the future. And so there's some disagreement. And speculation isn't bad. I just typically recommend that investors put less than 10% of their portfolio in speculations. Because in order to make money with a speculation, you have to be precisely right. You're only making one bet. It's going to go up in price because somebody will pay more in the future. With an investment, it's not one bet. It's that this income stream or cash flow will continue so I can collect that and earn some return that way. And hopefully that cash flow will grow and that'll boost returns and the price will go up. But it tends to be cash flow based. And then gambling is something with a negative expected return. And that's typically where you're betting against the house. You go to Vegas, the casinos have a positive expected return. Otherwise, they would go out of business, which means all their customers have to have a negative expected return. And you do that for entertainment. That's what a gamble is. Something where if you are exposed to it long enough, you will lose.
And that's essentially what lottery tickets are as well. There's a ton of money the state makes selling them.
And people know that, right? I mean, and why do the people buy lottery tickets? Because they like the feeling of dreaming about winning. They know the odds are against them, but you do it for the entertainment, just in case. And that's why lotteries are fun. But I mean, that's why it's also a gamble, because it has a negative expected return. And if you keep playing the lottery with all your wealth over time, you will eventually go bust on average, unless you get lucky.
And that's leaving the end result up to someone else. It's a lot better to create luck in your favor that you actually have control over than leaving it up to someone else's random chance.
Exactly. And that's what investing is. You have more control because of the income stream. And because if you go through the steps, you understand what the drivers of that investment is. Now, it's possible to invest in an asset class and not understand it at all, in which case it becomes more like gambling because we haven't done our homework to really understand how this works. And then we let our emotions take control, as you mentioned.
Correct. And I think there's a lot of companies today, especially in Silicon Valley, that are based on hype versus actual financial foundations. Companies like Uber, I think they're still not profitable. And I know WeWork just went through a whole implosion, and there's been many more like it. It's understanding the fundamentals of the fact that are they making money and where is that money going versus everybody hyping the next best thing that's out there.
Exactly. In fact, I love this quote from a startup, I think it was in Germany, where the CEO said that profitability is not one of our key metrics. So, I mean, that's something that they're after. That is another aspect of the financial markets that has changed. I mean, it used to be you'd have a private company. It would be funded by venture capitalists. They would figure out a profitable business model. They would earn profits, and then the company would issue stock to the public and then pay off the private investors. And then it would be a nice investment, hopefully continuing to make profits for the public investors. That's not the way it's been done. Typically, the private companies, they stay private for longer, on average 10 to 12 years. They continue to lose money, and then they go public, typically still losing money. So there isn't a way, they haven't figured out their business model yet. And then, I mean, that leaves the public shareholders holding the bag because the private investors got their money out. And now we have this company, Uber's an example, not profitable, publicly traded, gets put in the indexes, and essentially society pays the cost for that in terms of not figuring out how to have a sustainable business.
And it's wild because Uber specifically says we don't want to invest in assets, so they won't buy real estate. Like they won't buy their buildings. They want to rent them. They have no desire to actually build asset value, which is...
Well, and that's fine. I mean, if you have figured out a model that you can pay your contractors enough and that consumers are willing to pay for the product so that it exceeds your expenses. Uber hasn't done that. I mean, they're a taxi business and they're trying to do it on an asset light basis. But a lot of the problem with these gig economy companies is consumers are not willing to pay a price that exceeds the cost. I did an episode on this a month or so ago. My daughter and I, we drove for Uber, or not for Uber, for DoorDash. She drove, I helped. We did it 2 days. And what we learned was, once we factored in the cost of car ownership, gas, that we were making less than minimum wage. And the biggest cost was the insurance liability that we were exposed to, because with DoorDash and with Uber, their insurance doesn't kick in until you pick up the passenger, you pick up the food. So you have the vast majority of these gig economy workers are driving around uninsured until they pick up the food or the client. Now, that's a societal cost. If that driver gets in an accident, all right, who's going to have to pay for that? I mean, that should be baked into the business model of these businesses, and it's not.
And DoorDash just got in trouble for not turning over the tips, I heard. It amazes me.
We won't get into the DoorDash tip pile, but we saw that. I'll give an example. So after I did DoorDash, I ordered from DoorDash, which I hadn't done before. And I purposely gave a $20 tip to the driver. You do it on the app, because I wanted to see how much DoorDash paid them. And that's what DoorDash does. They said, oh, well, this guy gave a really big tip, so we're going to pay our driver $1 and then just give him the tip. So you can say it's ethical or not, but they essentially, they change what they pay the driver based on the size of the tip.
And so that's why it's always nice to hand people cash tips. You know where it's going. Today's episode is brought to you by Profit Comes First. Most business owners focus on the top line revenue, and while that's important, the bottom line, what you take home and what's available to reinvest in the business, is what drives continued long-term success. Hundreds of thousands of companies are using Profit First in their business. You don't have to learn fancy accounting systems or learn how to read complicated financial statements. You just implement the system and behave much like you currently do. However, you pay yourself first. Through our coaching and consulting calls, we ensure your business is on track, and I'm making sure you keep spending in line and increase your profitability. As a Profit First professional, I help entrepreneurs and small business owners to grow their business profitably. Learn more at profitcomesfirst.com and schedule a no-obligation call to see how Profit Comes First can help you put more money in your pocket. There's a scheduling link in the show notes. You mentioned Bitcoin, and this is something that I don't understand. What is the inherent value in Bitcoin?
The value in Bitcoin is the ability to hold essentially a digital asset that people believe has value. I mean, the value of anything, a speculation, it's only worth what people are willing to pay. People like the idea, I like the idea of having my phone and having a digital currency that I can send in to anyone I want without having to go through a central authority, a bank, or the government in order to do that. And so, to the extent from that aspect, it's like digital gold. It just doesn't weigh as much. That's the premise. Now, will it be successful or not 20 years from down the road? I don't know. But when you own Bitcoin or other cryptocurrencies, that's an example of a speculation. And so I have 2 to 3% of my net worth in cryptocurrency, recognizing it's a pure speculation, just to see how it will work out in the future. But I think there's definitely, it's not going away, but it might.
It's interesting how you do this, because you've said it a couple times throughout this interview. I invest in this knowing that it's speculation, and I do it to learn about it. And you're experimenting and seeing how things behave. And that's quite interesting that you have that mindset to behave in that way.
I do, but the vast majority of my investments and net worths are things that are highly predictable. So I am focused on cash flow generating investments. I own fixed income. I own dividend paying stocks. I own other income oriented strategies, both public and private. But yeah, on the margin, I'm experimenting.
And that's cool. And that's a smart thing. So just to be clear for listeners, right? The vast majority of your money is not in speculation, but we all want to sometimes have fun. And so you can create that separate small pot to go play with to get it out of your system so you don't mess with your main pot that is your income and your wealth building driver.
Exactly. Right.
So let's just talk a little bit about stocks, because I think, this year so far, the S&P 500 has been on a tear. In the past, when you look at historical performance, there have been, for probably the last, I guess since about 1983, 1982, we've literally been on a tear in the stock market. We've had ups and downs in that period, but we've had, I would say, higher than normal growth. Looking at the markets today and what the current PE ratios are, what do you think expected returns are going to be going forward?
Well, first off, the starting conditions always matter. So you mentioned the early 80s. The PEs of stocks in the early 80s would have been, I believe, around low teens, the U.S. stock market. So again, the three drivers of stocks, they're the cash flow in terms of the dividend yield. So in the early 80s, the dividend yield was over 3%. And then you had a very, very low price that investors were paying for that. And then since really 1980s, the cash flow growth as dividends have grown at about 5% a year. So we go back to the early 80s, the stock market, I don't have the exact numbers, but they've returned double digits. You had a 3% dividend yield, 5% earnings growth, and then the other 2 to 3% was to just the stock market getting more expensive over time. Investors paying more for those earnings in terms of the PE. So if we look at where we are today, the dividend yield is 2%. We can assume 4 to 5% for earnings. And then the wild card is what investors are willing to pay. If we look at price to earnings ratios, they're over 20 for the U.S. stock market. So if investors are willing to pay less in the future, then that will bring that 7% return down to, let's say, 5 to 6%. And if they get really freaked out, it could be lower than that. And that's where I say, as investors, these are the type of calculations we need to do. Not that we have to sit there and calculate it all. I mean, there are research affiliates, for example. They're a website that provide expected returns for different asset classes using the same methodology that I teach. And if you look at their numbers, they'll show an expected return for U.S. stocks of around 4% over the next decade. I think for a globally diversified portfolio, that a reasonable expectation is 6%. Now, most people don't have all their money just in stocks. They might hold bonds. Well, again, we can't just look at the historical return for bonds. Let's say the Vanguard Total Bond Market Index Fund, which has returned over 5% historically. The best predictor of future return for bonds is its current cash flow, what's known as a yield to maturity, or in the U.S., the SEC yield, which is that yield less the expenses of the particular fund or ETF. Right now, the Vanguard Total Bond Market Index Fund has a yield to maturity after fees of 2%. That's what that fund will probably earn over the next decade with a high degree of confidence. You can't be quite as confident with stock because of the wild card of PE. But with bonds, doesn't matter if interest rates go up and down. If you hold them for 8 to 10 years, your return is going to be very close to that starting yield to maturity. Because even as interest rates fluctuate, the price might go up and down, but then you're reinvesting. Interest rates go up, the price falls, but you reinvest at that higher interest rate. And so over time, it works out to where a longer term holding period equals that starting yield.
those numbers are sobering because I think, I remember a time where everyone said you make 15% in the market. Now, it went down to 10%. Then I'm hearing 8%. Now we're talking literally 2 to 4%, which means the ability to compound money is significantly altered.
Well, it is. It means investors were going to have to save more. And it worries me. You mentioned the FIRE movement earlier. It worries me, individuals that quit their job, say they're retired, maybe they have whatever, 200,000 to 300,000 saved, and their assumption is that they're going to earn 10%. This is not going to happen unless they're an absolutely brilliant stock picker.
And so I have actually the opposite story that I saw happen with my parents. When they retired, or as they were getting close to retirement, interest rates were through the roof. They were making 18% at one point in CDs. And even I think as they got close to retirement, interest rates were still 10%. Towards the end of their life, interest rates went down to literally 2 and 3%. So their income from their retirements went down 75%. And in that time, inflation also made things considerably more expensive. And so you saw a dramatic shift that happened there, and it causes significant cash crunches.
Well, it did. And hopefully in their case, that when interest rates were that high, that was back in the early 80s when the stock market was very, very cheap. And so in that case, having both the bonds and the stocks, they would have carried them through retirement quite well. It's going to be more challenging for those entering retirement in the next 10 to 20 years.
So realizing that it's more challenging, where else can people look to invest that they might be able to get better returns?
There isn't. I believe we should have obviously a diversified portfolio, but as interest rates have fallen, the returns on real estate, your typical property right now, is priced what's known as a capitalization rate. So the net cash flow after expenses is 5%. That's a reasonable expectation. People get confused with real estate because they're looking at their returns after taking on debt and borrowing to do that. Well, that's a different return driver. That gets back to understanding, what is the expected return irrespective of leverage. And so there isn't some magic asset class that's out there that's going to earn with a high degree of predictability 10% or more. They just don't exist because as interest rates have fallen, that has pushed up the price of all asset classes, which, as the price of an asset class goes up, the expected return goes down. So it's low across the board. Probably the most attractive asset class that I know from a yield basis right now are what are known as master limited partnerships. This is energy infrastructure assets, so oil and gas pipeline storage facilities. They're yielding 9%. The problem with them is there's only about 35 of them left. So it's a very, very small niche. And the future prospects for oil, aren't real great given how cost competitive renewable energy is. But that, barring that, that's the one asset class that has a very, very attractive yield right now. What's uncertain is to what extent will that cash flow grow over time or need to be cut.
And I think a lot of times people just look at 9% and they don't ask questions and they invest blindly, only to wake up one day and get sideswiped.
Well, and that's what I teach. That's why you got to look at all three. You got to look at the cash flow. That's cool. 9%. What's a reasonable assumption for that cash flow growth? On our models that on my site, we're assuming flat, that it's not going to grow. The cash flow, in fact, is going to be reduced over time, lowering the returns. And then it's an issue, what will investors pay down the road for that? And not that we're not predicting, but at least we need to have the discussion before you invest in anything. What has to happen to generate the return that I'm expecting when I go into the asset.
And so you need to think through what you're doing and have a defined process and understand it. So out of curiosity, I'd like to know, what other factors do you think might affect market performance? What I mean by that is, I've heard there's a lot of people who have put a ton of money into ETFs or into mutual funds, and some of them have grown to gigantic size, meaning that should we get a pullback and people start cashing out, that could have a ripple effect. We have an aging boomer population. I don't know what other factors are out there in the big demographics that may have impact on how markets perform in the future.
Well, I mean, stepping aside from the demographic discussion, it's kind of a long, it's hard to figure that one out. I mean, people have ideas, but the reality is, if populations shrink, Japan, for example, that has a negative impact, because over time, the earnings capacity of companies is tied to the growth of the economy. And economic growth, which is a measure, we use GDP, gross domestic product, that's a measure of the dollar value, the output created. The underlying drivers of that are, to what extent do you have more workers in terms of your population growing, and are they becoming more productive? I mean, that's what drives economic growth. So somewhere like Japan, that is expected to lose 30% of their population by 2050. I mean, it's not growing. So they have this headwind, which means they got to be ultra productive. Well, that's impacted the stock market. The Japanese stock market has never recovered from its big sell-off in the late 80s and early 90s. And I see a lot of investors, they just put it all in the U.S. market, assuming, well, I know it's my home market, things are going to be fine. But you look at political trends in the U.S., if there's a lack of trust in the system, then that could have a severe impact on market returns. If no one trusts anyone. In fact, if trust is the key to all financial stability. And if it's not there anymore, it's a scary world, not just from a financial perspective, but just from a life perspective.
And that is very true. I know you stated in the book that stocks have the potential for a 60% drawdown, and we've seen that in the past. Do you think people are aware of that and look at that, or is that something we still need to better educate people on?
That gets to the concept of risk. And one of the 10 questions is, what is the downside? Risk is not volatility for individuals. Risk is what is the worst case scenario, and what's the personal harm caused by that? So yes, stocks, the worst case scenario is about a 60% loss. Now, every worst case scenario was always bested the prior worst case. So they could do worse than that. But if we assume 60% loss in stocks, and that it takes, let's say, 5 years to recover, as investors, if we're trying to decide, well, how much should I put in stocks versus cash, we need to do the analysis. How would my lifestyle, my ability to meet my needs be impacted if the stock market fell 60%? Well, if you're in your early 30s and you don't have a whole lot of savings anyway, and you're saving for retirement, it's not going to impact your lifestyle. So you can have more in stocks. But if you're 2 years from retirement and your portfolio is 80% stocks or 90% stocks because you've never invested in bonds and you don't understand bonds, a 60% loss could be devastating to your lifestyle. And so that's how we can judge to figure out, all right, how much should I put in stocks? Well, how would my lifestyle be impacted by that 60% decline when it comes?
Which kind of brings us back to where we started this conversation about retirement and living a settled life. Because essentially, if you live a settled life and you have income well into retirement, you don't have to worry as much, do you?
No, and I think individuals should find a path, particularly given the low expected returns for asset classes that we talked about here, that they can generate income apart from the financial markets with a high degree of predictability. And maybe that's a side business. And as I mentioned, it can take years to figure that out. So at the same time that we're investing for retirement, we need to be thinking 10 to 20 years ahead of time. What else could I be doing to earn money, or that I would enjoy doing in the future, and figure that out as we go. And maybe it's continuing to work for an employer in a field that you love into your 70s. You're going to see more and more of that. And I think that's great. But it has to be something you like, right? You don't want to be at a job that you hate. So figure it out and give yourself time to figure it out.
Well, and I think that's the biggest thing. People are running around so much that they don't sit, and they don't have quiet, and they don't think. They're too busy on the hamster wheel. And you have to take the time. You have to step back, and you have to think about what is it that you really want in life, and how do you create that harmony across all the areas, and how do you become productive for society? And what's that all look like for you? Because if you're following somebody else's plan, you're probably not happy because it's not your plan. It's what you see someone else doing, and maybe that works for them, but it doesn't work for you.
Well, I agree. I think sitting back and thinking and looking at, all right, here's the areas that I'm curious about, and pursue one and experiment with that. And recognize that, most people aren't born, or even as adults, where they know what their passion is. They have to figure it out by trying different things. And then they get better at it. They get skilled at it. Joy comes from actually doing things repeatedly over time and getting better at it. That's what brings joy and satisfaction.
Interesting concept. And I think that's what people have to realize. Everyone wants the solution today. You're talking about a 10 or 20-year solution. It takes time, and even then you may have to pivot. So, based on our conversation, what's one action step people can take to move forward this week?
I would try something new. If there's an area that you're curious about, be it investing or outside investing, set aside some time to learn about it and try some things out in that area.
And that's always fun, right? Trying something new, a little bit of uncertainty, a little bit of excitement. We all probably have something in the back of our mind that are like, one day I'm going to do this. Well, it's one day. Go do it.
Exactly.
It's time to learn the secrets of life. What's your secret to living an abundant life?
To take time to reflect, in the sense of setting aside a time each day to meditate, to ponder, to pray, and to have that quiet time to reflect what Stephen R. Covey used to call it a private victory. So have a private victory in the morning, and that will help you have a public victory out as you go about your day interacting with others.
And if you start your day at the top, everything kind of follows, So it's a great way to get your day going. What did you learn later in life that you wish you would have learned sooner?
Wow, that's a tough one. I guess I would say just to be patient, that things usually work out. And so just realizing how long it takes to get good at something. Maybe that's what it is, right? I remember being young, I'd be frustrated as I was trying something new because I couldn't do it right away. And realize now how long it actually takes to get something good, to get good at something. That it takes years of practice. And through that years of practice, as I mentioned, that's what brings the joy, just to be more patient.
And I think you had an unusual start because you were 11, 12 years old reading self-help stuff and getting all that mindset stuff done early, which a lot of people, I know myself, didn't do till much later in life. So you kind of got a head start with that.
I did, but there's other areas that, I didn't get a really good head start on. So, we're always catching up.
Well, and you can't be perfect at everything, right?
Nope.
If you were to give an 18-year-old one specific piece of wisdom, what would it be?
To read widely, read books. The older the book, the better. I'm astounded how much wisdom there is in older books, particularly in, outside the Western canon. I quoted Kenko, who was in my podcast this week, who was a Buddhist, a Japanese monk. And you read his writings, and they're as relevant today as they were back in 1300 AD.
And so I've read some older literature, and I'm always amazed. I'm like, we haven't changed, right? The same advice that applies in 1300 or, 1 BC is still the same advice today. And a book that survives for more than 100 years has got to have some underlying value that it's still around after so long, because that's prior to the printing press, right?
Well, exactly. And that's a point that Nassim Nicholas Taleb has mentioned, that the fact that the longer something is around, the more likely it will continue to be around. And the reason why it's around, as you point out, is because people have found value in it. So literature that survived is valuable, and we should read it.
And that we do. I guess I was kind of lucky in that my kids were classically educated. And so they go back and in school, they always started by reading work from 2,000 years ago. And that's where they began their journey.
That's awesome.
So if people would like to learn more about what you do and find you, what's the best way for them to do that and to connect?
They can find information about me and my work at moneyfortherestofus.com. And the book is called Money for the Rest of Us, 10 Questions to Master Successful Investing.
And if you want to know what the 10 questions are, you're going to have to buy the book.
You can just preview it on Amazon and you can get at the 10 questions.
You can get the 10. We didn't dig into it today because I know it's widely available and people can do that. And that's fine. And I'll put the links in the show notes so that people can find you. Thank you so much for joining us today.
Great. Thanks, Rocky.
I really enjoyed David's thoughts on settled work, and I've given up on retirement. I'll always be doing something, but it will be what I love. It also may change over time because the world changes. However, I'll continue to work on improving myself in many areas, and I'll share that with you as I go on this journey. This week's action step, try something new. That's kind of cool. I like it. It's really not hard. You can pick something easy. What do you want to try that you haven't had a chance to? Give it a shot. Go enjoy. If we're going to get involved in investing, whether it's stock picking or 401ks or bonds or real estate or business, you need to understand the numbers and look at what the expected outcomes are. Most of the time, it's a math function. So do the math so you're not surprised. I do want to share David's 10 questions. Question 1 is, what is it? Essentially, what are you investing in? Do you understand it? The second question is it investing, speculating, or gambling? We covered that. Number 3, what's the upside? Number 4, what's the downside? Number 5, who's on the other side of the trade? If you're buying something, someone's selling it to you. Who is it, and what are their motivations? What is the investment vehicle? Number 7, what does it take to be successful? Number 8, who's getting a cut? That's a really big question. It's how are they getting paid? Number 9, how does it impact your portfolio? And number 10, should you invest? Fear of missing out is big. It's one that probably hurts me more than it helps me. If you're still listening, you must have liked the episode, so please share it with a few friends. It can start a great conversation, and I would appreciate it. You can also connect with me on Facebook, both on the Facebook page and the Facebook group for Richer Soul. What's preventing you from moving forward, and who are you putting on your team to help build the life you deserve? Taking no action creates a far worse outcome in life than trying something and failing. Can I help you achieve your goals through coaching and accountability? Just email me. We can start with a short chat to see if we're a good fit for coaching. For many people, one session allows them to take a giant leap forward towards their dreams. You can always get me at rocky@richersoul.com. I'd love to hear how you're doing and how the information I've shared has helped. Thanks for listening. Have an abundant week, an abundant year, and an abundant decade.